Hello, Explorer friends. On March 20, 2026, I'll introduce AT&T Inc., the friend that moved plots 2.13%. Hello, Explorer friends. The market handed AT&T a quiet little reward today, up about 2.1% on March 20th, 2026. Now, 2% does not sound like fireworks, but AT&T is not a fireworks kind of company. It is one of the largest, slowest moving names in the entire market. So when the tape lights up even modestly, the better question is not how far it moved. The better question is what the market thought it was buying. Let us get the numbers on the table quickly. The daily move came in at 2.13%. Over the last 5 trading days, the stock is up about 1.72%, so today was the bigger piece of a gradual drift higher. Volume landed around 64.6 million shares. We do not have a clean relative volume comparison today, and market cap was not provided in the snapshot, but AT&T is a very large company. We are talking about one of the biggest telecom names in the world. So 64 million shares changing hands is meaningful attention, even if it is not panic-level activity. The numbers confirm that something caught the market's eye. They do not by themselves confirm exactly what. First, let us not start with the headline. Let us start with the business. So is AT&T basically just a phone company? Not really. The phone plan is only the front door. Behind that door sits a massive connectivity infrastructure. AT&T owns and operates the networks, the towers, the fiber lines, the switching systems that keep wireless calls connected, home internet running, and business data flowing. For consumers, that means your monthly cell service and your home broadband. For businesses and government customers, it means dedicated internet connections, managed network services, and the kind of heavy-duty data plumbing that keeps hospitals, banks, and agencies online. The easiest way to picture it is like a digital utility. The same way a power company owns the grid and charges you every month for electricity, AT&T owns the connectivity grid and charges you every month for data. It is not selling you a shiny gadget once. It is selling you an ongoing relationship with a network. Let us reset the map for a moment. The real point is still where the money flow and the evidence actually meet. One-line memory, AT&T mainly gets paid to keep people and businesses connected every single month. Now, let us tighten the picture. Who actually pays, and what are they paying for every month? Here is the fork in the road where beginners often get lost. AT&T does sell phones. It does sell accessories. You can walk into a store and buy a device, but the device is not the engine. The device is more like the key that starts the car. The engine, the thing that actually drives the money, is the monthly service bill. Consumers pay wireless bills every month. Households pay broadband bills every month. Businesses pay for dedicated connectivity every month. Government and wholesale customers pay for communications infrastructure access on ongoing contracts. Almost all of the economically important revenue is recurring. It shows up again and again, month after month, as long as the customer stays. Then what actually matters more here, selling more phones or keeping the monthly bill alive? Usually the monthly bill, and that is why in telecom, a word you will hear constantly is churn. Churn is the rate at which customers leave. If churn goes down, the recurring revenue base gets stickier. If churn goes up, the company is losing the relationships that feed the engine. Beyond churn, there are a few other growth levers. AT&T can pass more homes with fiber, which means physically building the network to reach new addresses and then converting those addresses into paying broadband subscribers. It can upsell existing wireless customers into higher value plans that include more features, more data, or bundled services, and it can try to run the whole operation more efficiently, squeezing better margins out of the enormous capital it has already deployed. But there is a dependency underneath all of this. Telecom infrastructure is expensive. AT&T carries significant debt because building and maintaining networks costs billions. Interest expense matters, capital spending matters, and competitive pressure from Verizon and T-Mobile matters, because if rivals start offering better deals, customers can walk. For AT&T, the monthly relationship matters more than the one-time device sale. That single idea is the lens for everything that follows. With that map in hand, now we can look at what news hit the village today. The confirmed company action is straightforward. AT&T launched 3 new wireless service plans. Articles frame these plans as a move designed to keep customers from switching to competitors. That framing matters because it connects directly to the churn logic we just shot through. If the plans are structured well, if they give existing customers a reason to stay and maybe even upgrade, then the recurring revenue base gets a little more protected. So did the stock rise because 3 new plans are automatically good news? Not that fast. We still have to ask whether they improve retention without damaging pricing. A plan that keeps customers by offering more for less can protect subscriber counts while quietly hurting the economics underneath. The market seemed to like the headline, but the real test is whether these plans defend revenue quality, not just customer quantity. Now, alongside the plan launch, a couple of softer narratives floated through the coverage. Some articles leaned into a defensive or recession-resistant framing the idea that telecom bills are sticky, people keep paying them even in downturns, and AT&T is the kind of steady cash flow name investors rotate toward when uncertainty rises. That narrative is not wrong as a general observation, but it is not a company-specific catalyst either. It is more like background weather that may have helped the stock catch a breeze. So is AT&T basically just a phone company? Not really. The phone plan is only the front door. There were also mentions of AT&T testing AI-related tools for operational efficiency and customer service. That could matter eventually if it leads to real cost savings, but the direct proof right now is thin. It is closer to a future possibility than a present driver. Attention is confirmed. The full explanation is not. The strongest fact is the plan launch. The rest is market reading layered on top. Here's the part where we slow down and separate proof from market storytelling. Now let us hear what your Fox buddy thinks. The most plausible read is that the market treated the new plans as a retention and stability signal. In a business where the money engine runs on monthly billing, anything that suggests customers are less likely to leave gets a small reward. Investors may have liked the idea that AT&T is playing defense on its subscriber base rather than chasing risky, expensive growth. But there is a second layer. Part of the move may not be about the plans at all. It may reflect a broader lean toward defensive cash flow names in a market that feels uncertain. If investors are quietly rotating towards steadier stories, AT&T benefits from that current even without a strong company-specific headline. A more cautious read is that the market briefly rewarded a clean headline, and the real proof will only arrive later through actual churn numbers, average revenue per user trends, and whether competitors respond calmly or aggressively. This is interpretation, not proof. The plan launch is confirmed. The retention benefit is a plausible reading. The defensive rotation angle is a market-level guess. The final judgment on how much weight each piece deserves belongs to you, Explorer friends. Useful read, yes. Proven read, not yet. Now, 3 risks worth keeping on the map. Risk 1. The retention story has no visible proof yet. The market may be rewarding the new plans as if they will reduce churn, but we have not seen the data. If future quarters do not show better subscriber retention or a healthier customer mix, today's narrative can quietly deflate. The signal to watch is upcoming churn data, postpaid phone net additions, or management commentary that either confirms or fails to confirm improved retention trends. Risk 2. A competitive response could turn a plan refresh into a price war. AT&T launched new plans to defend its base, but if Verizon or T-Mobile answer with more aggressive promotions or switching incentives, the whole sector can end up competing harder on price. That can protect subscriber counts while hurting margin quality across the board. The signal to watch is new rival promotions, aggressive switching offers, or management language from any of the big 3 suggesting heavier competitive intensity. And if the plans look customer-friendly, does that guarantee better profits? No, because telecom can win subscribers and still hurt margins if the winning comes through discounting. Risk 3, the defensive cash flow narrative can fade if the broader market tone shifts. Part of today's move may reflect investors favoring steadier names in an uncertain environment. If that rotation cools, if the market swings back toward higher beta growth leadership, AT&T can lose that tailwind, even if nothing company-specific breaks. The signal to watch is a quick reversal in other defensive names, or a visible shift in market leadership back toward growth and momentum. Before we look ahead, here is a framework worth keeping. For mature telecom businesses, retention can matter as much as sometimes more than growth headlines. A plan change is not just marketing. It can be a tool to protect recurring cash flow. So the next time a telecom stock moves on plan news, do not stop at the surface. Ask 4 things in order. First, who pays every month? Second, what keeps them from leaving? Third, is pricing staying disciplined, or is the company buying loyalty with discounts that hurt margins? And fourth, after all the network investment and debt service, is there still room for healthy free cash flow? That framework is not just for AT&T. It works again for wireless carriers, broadband providers, cable companies, and really any subscription-heavy infrastructure business where the monthly relationship matters more than a flashy one-day headline. The bottleneck in these businesses is almost never, can they find new customers? The bottleneck is usually, can they keep the customers they have at prices that still make economic sense while carrying the debt load that built the network in the first place? Now, 5 checkpoints for the next session. First, does AT&T hold most of today's gain during the first hour tomorrow, or does the move fade quickly once the opening reaction passes? That helps show whether today's buying had real follow-through or was mostly a one-headline pop. Second, do Verizon or T-Mobile headlines, promotions, or analyst comments suggest a competitive answer to AT&T's new plans? The value of the plan launch depends heavily on whether peers stay disciplined or escalate the pricing fight. Third, do follow-up analyst notes and coverage focus on churn reduction and subscriber retention, or do they drift into weaker side themes like AI cost-cutting? This tells us whether the market is building its thesis around the strongest business-relevant driver or around thinner narrative add-ons. Fourth, does the stock trade like a company-specific winner, or does it simply move in lockstep with other defensive telecom names? That helps separate a true AT&T story from a broader sector or safety rotation. Fifth, do any fresh company comments or credible reports clarify what the 3 plans are actually designed to improve retention, pricing mix, bundling, or customer simplicity? The more specific the strategic goal becomes, the easier it is to judge whether the market's reaction today was grounded in something real. So here's where AT&T sits tonight. The company took a confirmed action to defend its subscriber base, the market gave it a measured reward, And the real answer, whether these plans actually improve the economics or just reshuffle the deck, will not arrive until the churn and revenue data catch up to the headline. The plan launch is a fact. The retention benefit is a plausible clue-based read. The broader defensive cash flow story is interpretation layered on top. These are three different weights, and they deserve to be carried differently. Use the story as a study map, not as a command. Let's check another company together tomorrow. See you. Let's check another company together tomorrow. See you.
We're all at you.